Hi guys, let's see this particular question which is being recorded on the request of a student. So let's go ahead and check this question. So first I'll go to the requirements of the question and then we'll look into the scenario as usual. So the requirement is estimate the potential annual percentage interest saving. Okay, this is regarding an interest question. Okay, interest saving that Galeplus might make from using a currency swap. Acha, this is a currency swap related question. Okay, relative to borrowing directly in per dia. Okay, so basically they're asking you what is the savings that can be made in terms of a currency swap. So just to give you a quick recap of what needs to be done. So we take the differentials between the fixed rate of interest in both the countries and also the floating rate of interest in both the countries, and the difference between the differentials will be the savings. And if they are sharing this, let's say the proposal of the swap says that one company gets 75% of the benefits and the other company gets 25, then you have to allocate into that 75 into 25% proportionate ratios. That's what we need to do. So moving ahead, the second part of the question talks about assuming the swap takes place as described, provide a reasoned analysis including relevant calculations as to whether Galeplus should purchase the communication center or not. Okay, there's a investment appraisal here regarding a communication center. Okay, the relevant risk adjusted discount rate may be assumed to be 15% per year. Okay, the cost of capital to be taken for discounting factor will be 15% per year. Okay, so with that being said, let's check the question. So looks like this is a 25 mark question. So let's see. Galeplus PLC, a UK based company, has been invited to purchase and operate a new telecommunications center in the Republic of Perdia. Okay, the purchase price is 2000 million rubits. The Perdian government has built the center in order to improve the country's infrastructure but has currently not got enough funds to pay money owed to the local constructors. Galeplus would purchase the center for a period of 3 years, after which it would be sold back to the Perdian government for an agreed price of 4000 million rubits. Galeplus would supply 3 years of technical expertise and training for the local staff for an annual fee of 40 million rubits after Perdian taxation. Okay. Other after-tax net cash flows from the investment in Perdia are expected to be negligible during the 3-year period. Okay, so basically there is a communication center. The Perdian government has built that center, but they were unable to run that center because of cash flow issues. So they are selling that to Galeplus PLC for a consideration of 2000 million rubits, not pounds, 2000 million rubits. But the agreement states that after 3 years, the Perdian government is going to purchase that particular communication center back from Galeplus at a consideration of 4000 million rubits. Okay, that's double the purchase price which Galeplus has initially purchased for, which is good. And apart from that, the company, Galeplus company, is going to provide 3 years technical expertise and staff training in that particular country. So they are going to pay 40 million rubits to Galeplus every year for the fees, basically. Okay, which is good. That's nice. Unless there is a huge inflation, this is a great scenario, because in 3 years your money, you are getting double of your investment, which is good. Unless the inflation is more than that, in which case we cannot do anything, we'll lose money. Let's see the inflation regarding situation. Perdia has only recently become a democracy and in the last 5 years has experienced inflation rates between 25 to, oh my god, that's 500%. This is crazy inflation rate that we are talking about. 25 to 500%. Is it 500 or 50? Let's see. I don't know, it could be a simple typo mistake as well. We'll see. The managers of Galeplus are concerned about the foreign exchange risk of the investment. Perdia has recently adopted economic stability measures suggested by the IMF. Okay, and inflation during the next 3 years is expected to be between 15% per year and 50% per year. Okay, so for the past 5 years, it is somewhere between 25 to 500. It is ranging between 25 to 500, the inflation rate. Whereas after the forex stabilization measures taken by, as prescribed by the IMF, so the forecasted for the inflation rate for the next 3 years is between 15 to 50%, which is nice. Okay, they're now coming into a controlled scenario, and therefore the gap between the lowest possible inflation and the highest possible inflation is coming down. Okay. Galeplus bankers have suggested using a currency swap for the purchase price of the factory, which is 2000 million, with a swap of principal immediately and in 3 years time, both swaps at today's spot rate. Oh my god. Okay, sir, so here you can see there is a currency swap being made. They're saying, the bankers are suggesting that today as well as after 3 years. The same amount, the principal amount of 2000 million will be swapped, the currency will be swapped, and the banker would charge a fee of 0.75% per year in sterling pounds. Okay, 0.75% in sterling pounds they are going to collect towards the fees, the banker's fees for arranging the swap. Galeplus would take 75% of the arbitrage benefit from the swap after deducting the bank fees. Okay, net savings into 75% will go to the Galeplus. Relevant borrowing rates are given. Okay, so sir, straightforward we can take this particular table as is, and I can just literally figure out the differences and we'll work that out.